This chart plots the TED spread, a metric tracking the perceived risk of banks lending to each other. For years, it hovered at a quiet 35 basis points. Then, in October 2008, it spiked to 464 basis points. The interbank lending system had frozen solid. The freeze in credit markets immediately triggered panic on the trading floors. The S&P 500 would quickly drop 57% from its pre-crisis peak. This bar chart visualizes the scale of the domestic fallout. From a high of $67.4 trillion in total U.S. household net worth, $12.1 trillion was completely wiped out over the next 18 months, pulling the global economy into its first post-war contraction. The spark for this systemic collapse came from a localized corner of the economy. A relatively small asset class of subprime mortgages began to default. But a housing bubble alone does not freeze the global banking system. The devastation was the result of a mechanical, cascading failure in a financial architecture built to concentrate risk while projecting the illusion that it was dispersing it. To understand exactly how a suburban mortgage default broke the world, we have to deconstruct this machine from the top down. And that starts by looking at the massive global liquidity imbalances that provided its fuel. In the early 2000s, following the dot-com bust, the Federal Reserve pushed its target interest rate down to 1.0%, a 45-year low. Around the same time, Federal Reserve Governor Ben Bernanke identified another structural driver, a global savings glut. Massive current account surpluses were building up in China, Japan, and oil-exporting nations. This created an estimated $500 billion in foreign capital annually, recycled directly into U.S. debt. As this dual-axis chart shows, this deluge pushed long-term Treasury yields down, even as the Fed raised short-term rates. This inverse movement became the Greenspan conundrum. With long-term yields compressing, traditional safe assets like government bonds were no longer generating sufficient returns for large institutional investors. This historic yield compression forced massive pools of global capital to aggressively hunt for alternative investments that could offer higher returns. Wall Street engineered a product to meet that exact demand. That product was built on subprime mortgages. Between 2001 and 2006, subprime originations exploded, jumping from $160 billion to roughly $600 billion. The banking sector achieved this volume by shifting away from the traditional originate-to-hold model, where a bank kept the loan and its associated risk. They moved to an originate-to-distribute model. Originators wrote loans, collected fees, and instantly sold them to securitizing banks. To qualify more borrowers, lenders popularized the 228 adjustable rate mortgage. This structure offered a low, fixed teaser rate for the first 2 years, but then reset to a variable rate, often 300 to 400 basis points higher. Underwriting discipline collapsed. In several metro markets, 30% of new purchase mortgages carried a 100% loan-to-value ratio, meaning buyers put $0 down. The entire engine relied on a single assumption, that home prices would continue their historic 85. The top slices were given AAA ratings, while the riskier, lower slices were rated BBB. But investors didn't want to buy the risky BBB tranches, so banks repackaged these leftover BBB slices into a collateralized debt obligation. By resecuritizing these tranches, they concentrated highly correlated risk. If one housing market failed, they all failed. The math actively compounded the danger. Yet rating agencies like Moody's and S&P assigned top-tier AAA ratings to between 80 and 95% of these subprime CDO tranches. They did this under an issuer pays model, where the banks creating the CDOs paid the agencies directly for the ratings. Furthermore, their models were built on historically limited data that did not account for a national housing recession. Stamping a AAA label on toxic waste solved the investor's yield problem. These CDOs bypassed regulatory constraints, allowing them to be purchased by conservative global pension funds mandated to hold only safe debt. Concurrently, a 2004 SEC rule change permitted the 5 largest U.S. investment banks to compute their net capital using internal risk models, insurance on bonds they didn't even own. This created a multiplier effect, expanding synthetic exposure far beyond the underlying mortgages. By late 2007, The gross notional value of the CDS market hit $58.2 trillion, exceeding the entire total global GDP for the year. Because of this invisible web of derivative leverage, it wouldn't take a total housing collapse to break the system. A small wave of actual mortgage defaults would trigger margin calls that far exceeded the total capital of the global banking sector. The true onset of the crisis materialized in August 2007, when BNP Paribas froze 3 of its investment funds, explicitly citing a complete evaporation of liquidity in U.S. securitization markets. Contagion quickly spread across the Atlantic. In the UK, Northern Rock suffered the first British bank run in 150 years, a clear precursor to the wholesale funding freeze that was about to hit the United States. By March 2008, collapsing CDO values destroyed Bear Stearns' liquidity. The Federal Reserve was forced to backstop an emergency fire sale of the firm to JPMorgan Chase. The true climax arrived in September 2008. Lehman Brothers filed for Chapter 11. With $639 billion in assets, it was the largest bankruptcy in U.S. corporate history. The domino effect across the market was immediate. The very next day, the Fed extended an $85 billion credit line to AIG to avert a default on its massive CDS book. Simultaneously, a $62 billion money market fund broke the buck, triggering a run on prime funds. The massive CDS market was entirely opaque. No institution knew which counterparty was holding the toxic exposure, causing global interbank lending to instantly freeze out of self-preservation. Policymakers were suddenly confronted with failing balance sheets of unimaginable scale, from Lehman's $639 billion to Fannie Mae and Freddie Mac's combined $5.4 trillion in mortgage exposure. The pre-crisis regulatory architecture completely lacked resolution tools for non-bank entities. This vacuum forced the government into a brutal binary choice between disorderly bankruptcy and full-scale bailout. The Federal Reserve slashed its target rate to the zero lower bound. Out of conventional ammunition, it established an alphabet of emergency lending facilities, like the Term Auction Facility and the Commercial Paper Funding Facility, to directly backstop debt markets and provide liquidity. The response required explicit international coordination, marked by a synchronized 50 basis point rate cut by 6 major central banks, and an eventual $5 trillion in aggregate fiscal stimulus commitments from the G20. In the U.S., the Treasury administered the $700 billion Troubled Asset Relief Program, or TARP. Though fiercely controversial, the bank-focused portion of the program eventually returned its principal to taxpayers with a near break-even gross recovery. The academic debate over the crisis continues. Economists like John Taylor argue that the Fed's loose monetary policy directly fueled the excess credit. Conversely, Bernanke counters that the exogenous global savings glut was the true driver of the yield compression. The Reinhart-Rogoff historical framework provides a broader context. Rapid credit growth and asset price appreciation predictably result in a severe post-crisis syndrome of multi-year output losses and prolonged unemployment. Ultimately, 2008 was the result of multiple mutually reinforcing structural failures. It was a system that engineered away transparency, compromised its own credit risk assessment, and allowed derivative leverage to outpace global economic reality. The legacy of Wall Street's meltdown remains a permanent warning of what happens when the financial machine outpaces the visibility of its operators.